Happy Monday morning to you. My name is James Boyd. Alongside with me is Michael Fairborn in the chat. Hopefully you had a great weekend. I had a great weekend with my two granddaughters, and I told them they were going to be my Valentine for this coming Valentine's Day. Kind of looking forward to that. One of my granddaughters, she's 2. The other one's 6 months old. Kind of excited about that. If you have any ideas of maybe Valentine's gifts, let me know. I have some ideas myself, but I'd always like to know. They were kind of looking forward to it, and it was great to be a grandpa. And it's great to spend some family time, but we're right back at it, and here we are on Monday. It's the first day of the week, so we want to actually get off to a fast, good start. Now, just real quick as we get started here, this class is on trading with technical indicators. So we're going to be looking at price, volume, volatility. We'll spend a little time talking about price, but volatility today, as we have some stocks like Google coming up today after earnings, after the close today. And we also have Amazon also coming up after Thursday as well. So I want to talk about some volatility plays, okay? Now, just real quick, also remember that we will definitely talk about some price movement examples. Most of our examples here today will be bullish, okay? Also want to give us a quick reminder that with what we discuss here, I'm going to just pull up something just real quick. Might have something right behind me causing that. I'm going to have to go to this. So just real quick, also remember that, pull up from that slide. Yeah, it's doing something weird. Just let me escape that. Okay. I'm going to have to just come to this. Yep. Okay. Yeah, that's weird. Let's see. Okay. Okay, there we go. Sorry, the PowerPoint was actually a little awkward. You know, something that's probably behind the scenes and can't click forward there. Well, that's okay. Now, remember, the information here is provided for general informational purposes only, should not be considered an individualized recommendation. They're examples. Our examples we actually do in the Paper Money account. Feel free to follow us along in the Paper Money account. That way you can learn. They're not recommendations, okay? They're examples. And we're trying to really have an understanding of trend, trading momentum, but also trading some volume and volatility as well. Remember that options carry a high level of risk and are not suitable for all investors. And also remember that when we talk about examples, they are just that. Investing involves risk, including loss of principal. And also remember that upcoming workshops we actually have, if you go to schwab.com/events, got 3 events, one in Scottsdale at the Phoenician, okay? March 7th and 8th. First day is technical analysis. Second day is option strategies. Also, Chicago Advanced Option Workshop, the 21st and 22nd. And also Detroit, April 11th and 12th. So those you can actually go to schwab.com/events. How much does it cost to go? To pay to actually be at the event? $0. You're really investing your time. And so join us there, okay? And they do fill up quickly, and that's not just like a sales tactic there. They do fill up quickly, and there's not just an indefinite number of seats. So once they fill up, they do close the registration. That's true, okay? Now, we also have Ray. Here he is in Ambros, France, and lucky him. So I want to make sure we give a shout out to him in France. And I used to live in Austria. My favorite place I lived was probably Innsbruck, Austria in 97. 1 hour radius around Salzburg. My gosh, it's unbelievable. So I will definitely be moving back. Love that place over there. So if you've never been, well, look at where the euro is now, and you might be having the chance to go. Now, just real quick as we hop right in, I want to give some quick market perspectives, okay? So first off, when we look at, let's say, the markets overnight, markets actually sold down pretty aggressively. We actually saw, and I'm just talking about just basic news. This is not politics. This is just flat news, okay? We saw the tariff discussion back and forth, if you want to call it that. Remember, sometimes we miss the point. This is not about tariffs. This is about negotiation, okay? Negotiation of terms, or things to try to make it better for one country and the other, to make it actually more of a meaningful relationship. And that's what it is between one country to the other. How do you actually make it more beneficial to both sides, not just one, okay? So one thing we want to kind of remember here is that news has an effect on price. When we actually see, let's say, kind of the indexes, and I'll first speak to commodities. We saw gold actually go down overnight, but then rally back at the start of the New York session pretty strong. Remember, we talked about gold, okay? Talked about it on Friday. Today, it's actually up about 25. Silver's also up about 1% as well. Copper's up 1%. It's really gold, though, that's leading the charge, okay? When you look at the volatility from that news, which, by the way, volatility is not necessarily all bad. Volatility creates prices to drop. And the price drop does not necessarily mean it's bearish. It could mean that the price drops down near the moving averages. And this is going to be a major theme of what we talk about here today. If you get suckered into every time the price drops that, oh my gosh, now you're distracted, you miss the potential chances to get in or to consider it. Let me repeat that. If every time the market drops, you kind of get suckered into like, oh my gosh, maybe the market's bearish, you're not looking to see where the price is dropped down to, and that could be the opportunity to get in or to consider it, okay? That's going to be our agenda, what we want to really talk about here today. How do we use volatility to try to get in, okay, or to consider an entry? Now, first off, VIX sitting here about up 2 points, 18, okay? So when news hits, some people say, I want to go out there and buy some of those puts. There are some things that are going down. Speaking of some things that are going down, semiconductors under pressure. We got two of those. We'll talk about those. Semiconductors down 76 or 1.5%. Russell's down 1.25%. I don't really talk about that much, but some people like to see that. We like to look at the Russell 1000, not the 2000. And also, if you look at the Dow Jones down 100 points or 0.25%, S&P down 47, 0.8%, NASDAQ down 0.89. Now, something that's kind of more material, when you look at the different types of trends, it's not the greatest signal per se when you actually get the VIX in trend 3. And the other ones, the best we can find is the Dow Jones in trend 4. Now, if we're in trend 4, that means the prices are right at the areas of resistance. That's not to say that it can't go higher. If we said, what is the price pattern of the day, we would say it's the cup and handle pattern. When we look at the relative strength over time, okay, that has been the area, the Dow Jones, that's really been the strongest. And if you look at the S&P, not as strong to itself. And you're going to see the NASDAQ trying to pop up, but struggling a little bit so far here today. Now, there are some tech stocks, though, that actually look quite strong. We'll bring those up here in just a moment. Sectors, just briefly, when we look at these, come to the sectors. This is going to give us kind of an area or areas we could go look. Now, I like to look at a list first and then the charts. So when I actually look at this and kind of look at this by, I could categorize this by week percent, or we could look at this in terms of, let's say, the RS5 is probably going to show something pretty similar. When I look at this, we see staples, we see utilities, we see healthcare, and if I kind of do that by percent, you're also going to see we see communications there as well. So when we see healthcare, we see staples, we see utilities. If you've been investing at all, you kind of know that's a little more protective type of stocks, if you will. Stocks that don't vary as much in terms of the revenue and earnings per share, maybe dividend paying. They don't tend to be as volatile. The key word is they don't tend to be, okay? But if you look at the IXC, we've been talking about that for almost 2 weeks. If we were talking about tomorrow, it'd be 2 weeks. And the biggest actually thing is things like Google, Netflix. We also have in that space as well T-Mobile, which we'll bring up as well, among others. Keep an eye on that. That's still been the area that has actually been quite strong. Now, let me just kind of just show this chart just real quick. So if I pull up IXV, IXV was down. It was. And if you look at this, kind of fired back. Just because it's down in the morning doesn't mean it's going to be down in the afternoon. Today, we actually opened up lower. This is an index, so I can't. If you looked at the product that actually trades prior to the market being open, it opened up lower, sold off intraday, and you're going to see it's a bullish engulfing straight back so far. You look at, let's say, the staples, what you're now going to notice is, again, gap down, sold off, rallied back. Someone bought that, okay? And you look at the utilities, and we're going to say when you look at the utilities, kind of trying to hold that 780 support level. Some of the stocks in there look pretty strong, okay? And the last but XC, and you look at that, it's actually right there. Now, the one thing we know, by the way, some of you might wonder if these are a different type of candle. That no, this is the regular candles. It's just gone up for almost the last 2 weeks. Okay, let's just leave it there. These are not Hakanashi candles, okay? But the way so many green candles in a row, that's kind of seems a little unusual, okay? Now, what I want to do is I want to kind of talk about, so first off, are there any questions? So if we kind of summed up what we see so far, yes, we see some price volatility, okay? Is everything bearish? No, it's not. The job of the investor is to find those pockets, and this never changes. The job of the investor is to find the pockets of where there's relative strength. Sometimes there's more relative strength, sometimes there's less, but there's usually something going up somewhere. Our job is to find it, okay? Now, if I take a look at this, I want to kind of pull up a couple stocks, and I want to kind of start with just real quick Costco, okay? Now, when you take a look at Costco, so one of the points I made this morning was when prices drop, like it did with Costco, it doesn't mean that price drop can't be right down to the moving average. That could be upward trending. Now, if the investor fell for it, a trap, well, they said, oh my gosh, the candle's ready to gap down, it's horrible, it's bearish. That's not trend. That's just price behavior at that moment in time. So it's not conclusive to actually say price is down, therefore the trend is down. That's very, very, very short term. Price fell down to an upward trending moving average and then went blink to the upside. Now, why do we care? Well, in the paper money account, let's just kind of look at this just briefly, see if we have an opportunity here. So in the paper money account, as you come to the classes, you'll actually see that we have the IRA account and then we have the margin account. Now, if I went down through here and said, is there any opportunity? Now, here's the thing. I'm an educator, but we're an educator / investor trader. The point of the education is we're trying to apply what we're learning to see if it's something we would consider as investors. Now, if we come down and what you're now going to see is we see what type of strategy is this? You got a long call and you got a short call. The long call is the lower strike and the short call is the higher strike. Well, that, ladies and gentlemen, boys and girls, is called a long call vertical, okay? Now, if we take a look at this, tell me, is there anything that we would do to manage this position? Now, think about the rule set we talked about, okay? Talk about the management. We talked about if we ever get 50% in the first 10 days, the investor might consider taking it. If the investor actually has 65% with 20 plus days to expiration, the investor might consider taking it. If the investor ever has 80% ever, the investor might consider taking the position, grabbing those gains. Now, if you looked at this position, did any with what I just said, does it hit any of those definitions? Well, this trade was really done on January 28th, and it's up about 64% in about a week's worth of time. Now, if I went back to Costco for just a second, how many of you actually think that maybe this might not be the top? How many of you think if you had a candle the size of the Eiffel Tower, that maybe this is not the top yet? Now, here's the deal. If the investor says, yes, I think this is the top, the investor might come in and say, I'm going to sell right into that prior high. Second option they might say is, James, I'm just going to exit the position and I'm going to maybe wait for the price to come down a little bit, maybe in the midsection of that candle, and then retry to get in. How many of you are thinking that? Now, so first off, I'm going to trade what we talk about, which is if we get 65% in, let's say 50% in the first 10 trading days, we're going to try to profit take. We're going to right click on this, create closing order, sell. Now, here's the deal. So we're going to sell that position and we're going to try to harness, okay, we're going to try to grab that 320 bucks. Now, does the investor have to, if they re-enter a new position, or called rolling, meaning exit what you have now and then re-enter a new position? If you do that, you think the trend could go where? You think the trend could go higher. That's really what you're saying, okay? Now, what I'm going to do here is I'm going to come back to this. We're going to hit sell. Why are we selling? Well, greater than 50% in the first 10 days, confirm send. Note the commission there, check, and we're going to send it. Now, if we thought there was a pretty good chance of maybe this pulling back a little bit, okay? And, you know, what might be a strategy that might be a little bit more forgiving in terms of price fluctuation, but also positive time decay. It's not the long call vertical, it's the short put vertical. So trade number one is we exited Costco. That was done in less than a week. Second thing we're actually going to do is we're going to re-up this position. We're going to go from a long call vertical that doesn't have positive time decay, has a higher profitability, okay, typically, and we're going to do a short put vertical, okay? So guess what we're going to do? We're going to come back into this, go to the trade tab. And what we're going to do is we're going to start with the monthly option. Which one is the monthly option? Now, I'm going to go out. This might surprise you, but we're going to go out to the monthly option if we take a look at this to the March. Now, some of you should be stoked about that because that means maybe the winter is getting close to ending. Now, if we look at this, I'm going to go back to, let's say, excuse me, there it is. And now what you're going to see is we're going to go look and see which strike kind of has a delta lower than 40. The delta lower than 40 is just saying out of the money. And if I chose something like this one or so, you're now going to see that we might consider selling the 980 strike or lower. Now, you got to remember something here is we will also want to look at the bid-ask spread, noted, okay? And we also want to kind of take a look at what's the open interest, okay? So if I said, is there some open interest on the 980? There is, okay? If I actually said in this case, is there open interest here, here, here? Not as much, but it's really there, okay? Now this might stun you. Don't be stunned, okay? We're going to widen this out because I've had some questions on this. What happens if you widen out the spread? Well, if you widen out the spread, guess what happens to the delta? Well, the delta becomes bigger. This trade almost starts to act like really more like a cash secured put because the delta is higher, okay? And you're going to see some different variations on the other Greeks as well. Now, notice when you widen out the strikes, the credit is bigger, okay? And when you look at the spread, $20 less the credit, there's your maximum loss. Now that maximum loss is bigger than what we can normally take, noted, but a little bit, not traumatic. But if you look at that, it is still a defined max loss. Now, what you're also going to notice is there's the second trade we're going to do. So you might say, well, James, no, this is the first trade. No, that's not true. We got out of the Costco position we had. We're going to re-enter a new position. If you roll, you are entering a new position. Now, notice the commission as well. And what we're going to do is send the order. Now, we're going to try to see if that actually fills, okay? Now, one thing I want to kind of make sure that we're clear on is when you look at Costco, you got to be thinking, well, what about Walmart, okay? Well, Walmart, what you're going to notice is it's also had a pretty good day. It gapped down, but where did it gap down to? It gapped down to where the old high was. The old high could become the new low. Okay? And if it doesn't come down quite to where the old high is, that's not necessarily bad. That could be a higher low. So the major takeaway I want you to take away is, consider, stop thinking that prices fall out in the morning is really like stuffing a fork in all the bullish positions. Because prices falling down could just be they fall down to the old high, become the higher low. Okay? Old resistance becoming new support. Second, the price falling down could just be right down to where the moving averages are, that's where a lot of bullish investors like to buy. Now, let's also go back to just real quick, one other one. And so we talked about Costco. I also want to go back to one area that, speaking of healthcare, is United Healthcare Group, okay? Now, let me share this chart with you, okay? Now, if we take a look at this and go to this, okay. Now, Paul actually talks about what's the guidelines for the days to expiration selection. So first off, we like to start a trade. We like to look at the monthly options. Why the monthlies? Well, because it tends to have more liquidity in those options. All the time? Maybe not, but it's the starting point, okay? Why do we like to go at least 20 days? Well, because we want there to be some time for there to be trend. The other thing why we start with 20 days is so that way if we want to get out 4 to 10 days expiration, if I got in with 20 days and I try to sell 4 to 10 days expiration, the trade only goes for about 10 days to maybe 16 days, which means it's only a 2 to 3 week trade. So we need to start with, or consider starting with 20 days, so that way there's enough time that if we want to sell prior to expiration, there's still some time to get out. So if we did the one in March, 42 days, and we said we're going to try to get out 4 to 10 days to expiration, then that trade really becomes like a 5 week trade, okay? So when we say days to expiration, we're talking about trading days, okay? That's our idea. When I say 2 to 3 trades, I'm thinking about trading days. Now, if we take also a look at, let's say, UNH, what you're now going to notice is this is a stock that has been kind of carving its way up higher, okay? Coming off these lows here. And on the bottom, I want you to kind of notice something, okay? There's been, I call them little chocolate chip cookies, okay? There, okay? There. And what's awkward about this is you really see those green dots known as hold. They're actually getting higher and higher and higher. Is that a bad thing? No, it's not bad, okay? Now, what you're going to notice is if I zoom in on the right-hand side, we actually had the green crop. Went from red to green on the 10. We actually saw the 20-period moving average go red to green. We saw the crossover, 1, 2, 3. If you look at recently, what has been acting like supports? Well, if we take a look at this, what you're now going to notice is, as I zoom in, we kind of see that the intraday low, okay, low, sitting right on the 20-period moving average. 4 times in a row, we've been seeing price drop. Now, that goes back to the point of this class. If you think every time the price drops, then you're probably not going to be very good as far as buying on support or near there. Okay, so I'm trying to condition you. I'm trying to reprogram us all. When the price drops, that could be maybe the opportunity. Okay, so if you see the price drop down in the moving average, or maybe an old resistance, new potential support, be looking for the lower shadows. The lower shadows are confirmation that other investors not only saw it, but bought it. Okay, now look at where we are now. A little bullish engulfing candle so far. Now, what I want to do on UNH, trade number 3. I want to come to UNH, and I want to actually go to this. And by the way, the question came, Roy says, are there any regular coaching webcasts dealing with longer DTE options, example, 6 months plus? Well, so we like to take a minimum 20 to 40 days expiration. That's a starting point on the monthly options. Now, here's the deal. Wonder if we wanted to go a little bit farther out in time. 17 April. 73 days. It's not 6 months. We don't mind to go farther out. We just need to verify if we go farther out, is there liquidity? So let's say we went out to April's, okay? 73 days expiration, okay? And we said, hey, I want to do something like a long call vertical. I want to trade this to the upside, thinking there might be a chance that we could break inside that old range. Now, a lot of times people think, well, that's the major line of resistance, and I'll get in as soon as we get above that. And those are the famous last words of the person that maybe never gets in, okay? Or rarely, okay? Sounds good, but the execution might be lacking. Now, we're going to try, now, someone might kind of break this also down in terms of position sizing. If they said, James, I normally buy with 2 contracts, or I normally buy 50 shares of stock or 100 shares of stock, they might try to buy some shares of stock before the breakout, provided that there's an uptrending support line, which there is, which there's provided that we also see some higher lows, and that's what's creating that upward trending line. So it's not like they're buying the stock in a downtrend. They're just trying to dollar cost average, whether it's shares or options. Now I'm going to go to the trade tab. And what I'm going to do to this, I'm going to go out to kind of Roy's point, not as far, but we'll go out to the April. Now, by the way, why is it maybe a good idea to consider changing the duration of some of the options trades? Is it a great idea to have all of your expirations in the same month? No, not necessarily. Okay. Wonder if in that duration of time, 10 days, 20 days, whatever, the market goes down and all of your options are in that one time period. Not great. Okay. Good luck. Okay. So the investor, sometimes it's okay to vary the expirations. You still need to check the bid-ask spread, still need to verify what is the open interest, of course. Now, this is a higher dollar stock, noted. With a higher dollar stock, the bid-ask spread tends to be a little wider, noted. But when you look at the open interest, it's still a couple hundred contracts. So what I'm going to do here is I'm going to do the 550 and the 560, okay? Now, when I do this, got a $10 wide spread. Debit is $4.95. The debit is the most we can lose given the vertical. When you look at the maximum gain, it's just the spread less what the debit is. So the maximum profit there is going to be $505 maximum profit. Now what I'm going to do is we're going to put this right back in that paper money account, and let's do this. I'm going to go out to the Aprils, and we said the 550s and the 560s. There she is. Okay. Now when I pull this up, we're going to put this right in the IRA. Okay. Now notice for the trade, there is the commission of $1.30 noted. Okay. Now I'm going to tell you something. If you never learn what a vertical is, a long call vertical or a short put vertical, you kind of maybe leaving something on the table, because a lot of stocks are higher priced. Verticals at least give the investor the option to consider, how do I actually consider trading these higher price dollar stocks? Yes, I could buy some shares of them, sure, consider it. But the other way to actually do it is through the use of the strategy of a vertical, a long call vertical and a short put vertical. Trade number 3 is we're going to do UNH. Okay. Now I want to come back to this just real quick. So when we go back to the so let me give it a quick example, okay? So can we buy higher price dollar stocks like Google, okay? And I need your help here, okay? Google today has earnings, today, okay? And we bought those shares about a month ago. It's up $6 per share, and we have 33 shares of stock. Now, if you go to, for example, the chart, is this something we would consider in exiting? Now, the problem with actually a stock and setting a stop is it's a trigger to sell, but it doesn't necessarily tell us where it's going to sell at. Now, this is up to you. Would you consider selling here, or would you say, James, let it play out over earnings? Any take here. Now, the comment from Indy TLC is, why the long call vertical versus a short put vertical? Easy answer. The long call vertical, if you think there's more upside potential, that investor would probably choose a long call vertical. Why? Well, because you have higher profitability, okay, typically. Why do the short put vertical? If you did the short put vertical, you are really trying to play more of a probability-based trade, more forgiving typically if you take the structure that we talk about, and it's positive time decay. So if I said the comment like, man, I'm pretty confident that this one could go up, that investor would probably choose a long call vertical. Next trade, I think it could go up, but I don't know how confident I am. They might choose a short put vertical that's more forgiving because it has a lower break even. Okay. Now, Dean actually says hold it over earnings. Now, that's what we're going to do. We're going to hold it over earnings, but I'm going to do 2 earnings trades. Now, why am I going to do 2 earnings trades? Okay. So first off, I want to kind of show you something, because the other thing we want to kind of talk about is when we talk about trading with indicators, it's not just price, it's volatility. Okay. Volatility, your favorite word of the day. Now, one of the indicators that we actually use is the IV percentile, which is what you'll see on the trade tab. And then the T is for technicals. Okay. Now, every Friday around earnings season, I will post which companies actually have earnings upcoming, et cetera. So that way you have an idea of what is going on. Okay. Which ones the investor might say, hey, is on the radar screen for next week. Well, the one thing that we actually see this week that it actually is pretty high, you're going to see that Amazon is in this list, and it has it's the 72nd percentile. That is the same as if you went to the trade tab and looked at the bottom left. So when we have a higher percentile, it just means that the current IV over the last year, okay, where it currently is in the 72nd percentile over the last year. Now, is that a potential interest? Yeah, for some investors might say, well, I might consider a selling strategy. We're going to come to that in just a moment. But if I actually also pulled up, let's say, Google on this, let me see if I have Google in the list here. Let me try to pull it up. Google, do I have it in the list? Yeah, it's right there. If I look at Google, it's at the 67th percentile. Now, for some investors, they like high implied volatility. High implied volatility, bigger premiums. Bigger premiums, lower break-evens. Lower break-evens, greater chance of potentially be right. Now, what we're going to do is on Google is we're going to kind of, now if I were to ask all of you, Luke, Kirk, Alexis, if I said to you, where do you see support on this chart? Where do you think it is? Okay. Now remember, could we buy the shares? We have the shares in the paper money account as an example. But what if the investor want to do an option trade? They want to kind of do something more based on probability. Well, if we said, where do we see support? Some investors might say, James, that 190 area, I would agree with you. Carlos agrees. Okay. So what I'm going to do is I'm going to go back to the trade tab. Now, when the investor says, well, which expiration could we select? Now, notice there's a big difference between the options that expire this Friday, okay, next week, and next week, and the next week, and so on. Why is the implied volatility going down? Why? Well, the implied volatility is the highest this week because of earnings. The forward expected move, okay? Now, we could see what the market maker move is, $11.90 up or down for the earnings, or we could actually see what the forecast is, plus or minus $12.98 for this Friday's expiration. So they're thinking it could go up or down, let's just say $13-ish. Now, what I'm going to do is the investor might say, well, James, I'm not sure, and I'll open up both these. If the investor sells the options that are this week, they're probably going to be a little bit more, there's some decent premium there. If the investor said, James, I'm going to sell the 200s, they're $500. If they sell next week's actually 200s, they're $555. So they are a little bit more because there's an extra week. But this week's premiums or option premium is almost as high as next week's. Why? Earnings. Okay. Now, we're not going to do the 200s. Okay. Now, I'm going to show the example of both. I love to compare and contrast. Love it. Okay. Now, what I'm going to do is I'm going to come down to the 195s. I'm going to sell the 195s. And what we're going to do is we're going to buy the 190s. And we're going to do it in this week's expiration. And we're going to do it in next week's expiration. So this week and next week. Now, why are you going to do that? Well, I want to kind of see the differences between if the price were to go up, sideways, or down, what happens? So in our fourth trade example, we're going to pick the February expiration, and I'm going to kind of, let's go to there. We said the 195, 190. Now, repeat back to me what I said, okay? If we did a short put vertical, why am I picking a short put vertical? What's going through my mind? Well, if I did a short put vertical, there's a clear reason on why we're doing a short put vertical. I don't know what the reaction is going to be over the earnings. I don't know. And so what I'm going to do is I'm going to try to get a credit of $1.34, and that, if we subtract that $1.34 from the short put strike, you're now going to see that we get a break even of 193.66. So if the stock is at 203 and we have break even this Friday of 193.66, the stock could go down about $10 and still be at break even. So if you chose this strategy, you're trying to have a little bit more buffer, just in case you get the direction wrong. Now, if we said, well, when would it make the whole $134 a contract? Answer, it needs to be above 195 at expiration. All right, so what we're going to do is we're going to do one of this Friday and then one of next Friday. Now, when we look at the max loss, we're going to do this also in the margin account. We're going to sell one, and we're going to do one in the IRA. Now, when I do this, there it is, and I'm going to now go down to the 14 Feb. And now if we did the same thing, the 195 and the 190. And if we did that, now what you're going to see, verify the strikes, you're now going to see the credit there, $1.41. Now that's pretty mind-blowing when you think about, wait, didn't we just get $1.34 for this Friday's expiration? And if I win another week, they're only going to give us 7 more cents? Yes. So why is that? Volatility. Now, what's the risky part of this trade? The risky part of this trade is it's short. We're going to know on Friday, did it get a maximum gain? Did it get a maximum loss? Or is there a partial maximum loss? We're going to get the outcome a lot sooner. Now, notice what we're also going to have in this case is we're going to move it to the 143, try to get that credit, confirm and send. Now that price change on us, 141, confirm, send, note the commission, send. Okay? Now what we're going to try to do is kind of compare and contrast. Now the other risk to this is if we're selling options that are so close to expiration, someone on the opposite side of this trade who is long has a right to exercise, which means the paper money account is short and they have an obligation. So when you're doing options that are this close to expiration, you need to be mindful of that obligation risk or assignment risk. Remember that, okay? Now, what I'm also going to do is let's go back to the Amazon example, and I want to do this from a stock perspective. Now, Amazon today was down. It was, okay? And guess where it went down to? It went down right pretty much to the old high, to the blasted penny, okay? So if I take that old high, okay, so if we had a mentality, oh no, Amazon down, everything, okay, if we're crying about prices are down, it's going to be hard to see the prices down to where? Well, old high can become a new potential support. And if you start to see buying near that area, someone's trying to take advantage of that news. Sometimes the news can be the opportunity to shake the prices. Okay? Now, you got earnings coming up. This is on Thursday. Now, what I want to do in this example is, how many of you have practiced our caller examples? What in the heck is a caller? Well, number one, we're going to buy the shares of the stock. Step two, we're going to sell the call. You have the shares, you sell the call. It's a covered call. It's the most basic option strategy there is. Now, if the investor said, but James, I'm concerned about the downside, where kind of it takes that next step is, could we use the option premium from selling the call to buy the put where we have downside risk protection and a pre-built defined risk over the earnings? That's what we're going to do. Now, what I'm going to do on this is I'm going to bring back up, so trade number 5, okay? We're going to go back to Amazon. And step number 1. Now, how much cash do we have on this account? Well, we got about $80,000. We're going to come to that ask price. Step number 1, we're going to click on the ask price of the stock. Now, I would like you to practice doing this order with us. The best way you really learn and see if it's something you would consider is you practice it in your paper money account. Not a recommendation, but we need to kind of see side-by-side examples, okay? Now, what I'm going to do is I'm going to click on the ask price, and it just says we're buying the shares of the stock. Noted. Now, step 2. We're going to come down to where it says first triggers SEQ. This just means do it in order, okay? Step number 1, buy the shares of the stock. Step number 2, sell the call. And step 3, buy the put, okay? Now, what we're going to do is I'm going to do this a little bit shorter term. We're going to sell the call with something that has less than 20 days expiration. Now, could you go farther? Yeah, you could. Why would the investor maybe not want to? Well, maybe they don't want to have a pending obligation out that far. Maybe they just want the obligation to be shorter term, meaning they don't want to cap the stock out 70 days from now. Maybe they just want to cap the stock for the next 18 days at the 250 price level. So step number 2 is we're going to sell the 250s. Now, when we sell the 250s, click on the bid. And when you click on the bid of the option, we actually now see we have a 250 call, and that 250 call is at $4.95. Now, when you have earnings, what you have to expect is the puts are probably going to be higher priced than the calls. Why? Well, because people they tend to be a little bit more nervous, and they're willing to pay up more for the puts for downside risk protection. So we're going to come over to the put side, and the rule of thumb that we like to kind of look at is we like to, maybe make it what we call a zero cost collar. Meaning, if we collected $4.95, then we're going to try to come look at a strike that is maybe right around $4.95. If we collect, okay, so if we collect, if we buy the 227.5, and I say, look, I'm going to try to buy it at $4.95, that means the premiums offset each other, okay? Hence the zero cost collar. So the investor has from $238 up to $250, which is about $11. And they have from $238 down to $227.5 in terms of their maximum loss. So this is kind of mind-blowing because a lot of investors set stops, but this is not setting a stop. This is a right to sell for the next 18 days, okay? And this becomes a defined risk trade. So trade number 4 we're going to do here is if we go to confirm and send, now you might be blown away by this and say, well, James, this is like 25% of the account value. That's true, but it doesn't have an undefined risk to the downside. The loss is still right at that 1% threshold of what it could be. I could pull up the numbers. We could relook at it tomorrow as far as the numbers. But what you're now going to notice is it still could be done, okay, given what the loss could be. So step number 1, it buys the shares of the stock. Okay, we can see that down below. There's the shares of the stock. And then what we have outstanding is the order for the 250 call and the 227.5. So that order is still there. Now I got to wrap this up. The one we also want to keep an eye on as well is T-Mobile. That's the one that was also down in the pre-market, but then bounced back up. And if you saw my X, we posted about that. The other one we want to really keep an eye on is IBM. We talked about this last week, and what do you see on the chart? Pop to the upside, traded inside the previous day's body on Friday, bullish engulfing right back. IBM stiffening here to the upside. If you look at Meta, we thought 700 was the top. Someone obviously used the gap down in price as a buying opportunity. Bullish engulfing straight back to the upside. Keep an eye on Meta as well. We also want to keep an eye on, let's say, Fortinet, which is kind of right up near the area of resistance. It's also an earnings play this week as well. Palantir as well. And that is going to be today. Okay? So Fortinet and Palantir. And the last one that I'll really bring up quickly is a real estate one called Welltower. And if you look at Welltower, that is your classic cup. And if you look at kind of what price pattern do we see out there the most frequent right now, the answer is cup and handles. Okay? So the point we wanted to get across today was try to rewire yourself in terms of thinking the price is down. When prices drop, a lot of people become fearful. The reality is you want to kind of say, look, when the prices drop, I want to put that in context. Where's the prices drop down to? And if they drop down to the old high, they could become the new higher low. Old resistance, new potential support. If the prices drop, then they might drop down to the moving average. And if that moving average is uptrending and there's not much of a lower shadow, then you're actually seeing that other investors are trying to buy on the dip on negative news. Negative news, if you're a buyer, is the opportunity to try to use the negative news as a potential entry as it pushes the prices down, sometimes even just intraday. So that's kind of the focus we had here today. We did 5 examples, okay? Today, practice those alongside with those in your paper money account. Also, I want you to go out and kind of be looking for these example trades over earnings. Practice using a vertical type strategy. Practice using a collar type strategy. They're all defined risk, okay? So stay tuned for Cameron May coming up right at the top of the hour. Thank you, Michael Fairborn, for answering those questions in chat. And I will also post the link for today's session and our channel right in the chat just right after we're done here. Remember, with what we discussed, it was done for example illustrative purposes only. This has been the class on trading with technical indicators. Thank you so much. Take care. Bye-bye.